Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in today's very important webinar, that is 123rd CP program organized by AASB of ICI this year. The topic is very, very relevant, as you are all are aware that we have covered all the standards on auditing as well as all the aspects of asset side as well as the liability side. Then we have started various industry-wise audit considerations, and today's very important industry, that is the IT sector. And today we are organizing this particular program, key considerations in audit of the IT sector. In order to tackle this, we are having very learned speaker, C. Darshan Verma ji with us. So on behalf of AASC of ICI, I extend my warm welcome to you, sir, on this CP program in the form of webinar organized by AASC of ICI. Welcome to you, sir. Namaste.
Thank you very much.
I also welcome all the participants of today's webinar who are registered and logged in for this particular webinar. So before I proceed further and start the webinar, it is my proud privilege to share with all of you the brief profile of our today's learned speaker, C. Darshan Verma ji. Darshan ji is a partner with the Financial Accounting Advisory Services and specializes in IFRS, US GAAP, Ind AS, process improvement, digitization of financial reporting. He works with clients in the technology, manufacturing, FMCG, automotive, and infrastructure sector. He is a fellow member of the Institute of Chartered Accountants of India and holds a bachelor degree in commerce. Darshanji has over 23 years of auditing, accounting, and consulting experience. His accounting advisory services under various gaps, capital market offerings, IPOs, SPAC, REIT. He is having extensive knowledge of ERP and other tools like SAP, Oracle, etc. Also, he has extensive experience in handling multinational, multi-location clients and Indian companies. He is having core audits of financial statements under various gaps. As far as the professional skills are concerned, prior to joining the firm, Darshan has having worked in with global IFRS audit division of Fortune 500 company in Germany for 3 years, doing SOX audit and IFRS audit. He was also worked with two big four consulting firms over 11 years, providing audit services in accordance with the Indian GAAP, Indian tax laws, IFRS and US GAAP, and implementation of technology solutions. He has also worked on large multinational inbound accounts in various sectors and has sound experience in various GAAP and Sarbanes-Oxley as SOX requirement. In recent years, Darshanji has leading the digital finance function for EY FAAS in India and has built products of EY FRS. Darshanji has extensive audit and consulting experience spanning across a sector of industries including F&A services, energy sector, automobiles, IT, consumer goods, pharmaceutical, infrastructure, and the Indian GAAP, US GAAP, and IFRS. Darshan he has having reporting is having good knowledge of accounting and reporting issues and regulatory relevant to Indian and multinational companies operating in India. His experience in capital markets, including pharma client, healthcare, and real estate. He has led training for audit and accounting matters, Indian GAAP and India's for the firms and client personnel. So list is still long. So without wasting much more time, once again I welcome to you Darshanji on this Zoom platform for 123rd CP program in the form of webinar organized by AASP of ICA. So I request you to please deliberate on the topic and enlighten all of us on various intricacies on the audit consideration in the IT sector. Over to you, Darshanji, please.
Thank you very much. And I really thank the Institute for giving me this opportunity of sharing my professional knowledge. It's my humble request to all of you to pay attention over the next 120 odd minutes. The whole idea of this 120 minutes of all of you spending together with me is to also make sure that whatever learnings we can gather from this entire seminar, you will be able to go back and replicate when you're executing your audits. I'm also humbled with the fact that ICI has also recognized and requested me to do this presentation. I have done this with many other bodies and also the CA Institute at the COE. And I really again thank the Institute for giving me this opportunity. With that brief introduction, let me switch my presentation. I want to just confirm that all of you are able to see my presentation in the presentation mode. Once you confirm that, and I'll get started. Hemal, is the presentation visible?
Yes, sir. No, sir, not yet visible, sir.
Let me share again.
Yes. Yes. Sir, change the slide. Next slide. Now it's fine, sir. Fine.
It's moving. Okay, great, great. So thank you,
Thank you.
Anilji. Thanks for this introduction. This is an unstructured training program. There'll be no fee attached to it. All of you have to give all the membership details. I think the CA Institute will take care in terms of you have to update the CPE program details. Unfortunately, both Mr. Singhal and Mr. Doshi, who are in a physical conference, are unable to attend this session. They have requested leave of absence. Pending that, we are all there logged in. Thank you very much for dialing in. So let me walk you through the entire key consideration for audit in IT sector. Why this sector is very important. You must have seen about various other sectors, the unicorn, the sonicorns of the world. Those are all the emerging sectors. But the one sector which has given us the branding of IT, the country being the service sector of the world is the IT sector. The big boys in the sector are all your TCS of the world, the Infosys of the world, the HCLs of the world. So there are large multinational companies, Indian multinationals, keep in mind that all these companies are now worth billions of dollars, market capitalization also, and now they do global contracts. This sector has been a booming sector, providing a lot of employment. Also, because they have done more and more complex things, it also becomes very important. We, as an auditing profession, whoever has got into audits of any of these companies, to make sure that the auditing is of highest quality, because they themselves would have managed a lot of their accounting, finance, reporting function at the highest level. So I'll walk you through in two parts. The first portion of my session would focus on how you should plan for an audit, especially in the context of more and more things being digitized, more and more things being automated, less and less things being done manually. What is the expectation of the industry, especially the IT industry, from an auditor? They will expect us to be much more digital savvy, much more technology savvy, much more in the know of lot more things which are happening in their sector, so that when we are framing our auditing questions or framing the way we conduct an audit, they will expect us to be more and more digitized. So that is one set of expectation which the industry has from us. So through that expectation and also the auditing standard, how should we make sure that the auditing which we carry out meets the auditing requirements? So that will be the first portion of my session here. Post, once I set that context in terms of how you should carry out an audit, which most of you will know, but I'm going to refine those in terms of the IT sector. Once we close that loop, then we go on to specific issues within the IT sector, because there are certain things which are nuanced within the IT sector, be it the revenue recognition contract, be it the acquisition which they keep doing, reorganization which they keep doing, the leases which they enter into. All of those have a significant impact on their financial statement, balance sheet, and their market capitalization. So I will dwell into some of those topics in detail, give you information in terms of how should you deal with those aspects once you are into that particular sector and auditing that company. So that's how I'm breaking this entire session into two parts. One part is to focus on the basic fundamental principles of auditing and linking it back to IT sector, and second is the specific topics in relation to IT sector. So without further ado, let me jump into the session. So in terms of what is changing from an external factors, all of us know over the last 3 years, all of us were impacted by COVID. I'm hoping that there has been no loss of life. If you noticed, post-COVID, the way it got accelerated, especially digitization, uh, uh, today is a classic example of how digitization or automation has taken over. None of us would have probably thought about doing this kind of an all India seminar. I sitting out of a location in Hyderabad in my office, you sitting across the country, across the globe, are able to listen and are able to do a meaningful interaction. That is possible only because, whether it's the good part of COVID or the bad part of COVID, but the acceleration of digitization became very imperative, and that's when the global is driving the agenda. I'm going from left to right. So if you notice here, from my left side, there is global drive towards delivery on digitization agenda. This is all driven because COVID pushed a lot of things to say that, okay, we cannot be sitting out of a particular location. Also, it so happened that there was the concept of All of you must have heard the great resignation. There was talent war. A lot of people, a lot of companies lost their existing talent, very good talent. They lost it with competition who were willing to offer salaries in excess of 50%. So all that impacted the way things had to be done. Previously, if it was a person-driven organization, COVID taught the companies to say, hey, if we are losing this person, he or she, you cannot be focused on that person-driven organization. You have to move into process automation technology, and that's where the drive happened. And more importantly, there were certain sectors which were badly impacted. There were certain sectors which were positively impacted. All of this led to mergers, acquisition, carve-outs, divestitures, and integration. We'll talk about this because this has an accounting implication. This has an audit implication. So this also came out of all the challenges which you saw in COVID. Now, apart from all this, there were regulatory changes which also happened. Now, all of us know the GST changes which were constantly happening, the new revised Schedule 3, which brought in a lot of changes in our financial statement. That became another issue. SEBI came with a lot of requirements on related parties. So there is a lot more changes. And to keep pace with these changes is also not easy. We as auditors have to be constantly reading. I keep saying this to all my team members that the day I stop reading, that will be the day when I start growing and I'll start degenerating. Because in the professional services firm, if you stop reading, the next day, if there's a question from your client saying that how do you deal with this particular issue, and you don't have an answer, the client will not waste a minute to go to another auditor, another consultant, another advisor to take that advice. So it's very important that we are always in the know of things. So that's another important thing from a regulatory point of view. Apart from this, there were a lot of things which I keep calling in terms of how there was investor activism. You must have heard about how today there is a conversation of one of the largest FMCG companies paying additional royalty. So there is a lot of news around it. Why are they paying so much royalty? So there is a lot more investor activism. There are proxy advisory firms who are coming and telling the investors how they should vote or how they should react to this particular resolution. So there is a lot of investor activism. Then there is collaboration between competitors. Who would have thought that there will be collaboration between competitors? Toyota and Suzuki were competitors. Today, you see them as one platform. They launched the same product with co-branding. So you would not have expected these kind of changes. So there are joint venture agreements which are happening. There are a lot of focus on how do you collaborate together. And you saw a big collaboration which was happening within the pharma sector. They were sharing information in terms of what the results of each of the tests were. This is how the vaccines could come out very quickly. All of this is changing the way the businesses are being done. The way once the business has changed, the way it will come out in the financial statements on which we as auditors have to comment will also pose a challenge. Because if we do not change the way we audit, because there is so much changing need, then you will have a bigger challenge in terms of dealing with that client. We all dealt with it, and rightly so. I think auditors and the CA Institute was in the forefront of dealing with COVID challenges. One simple example, which many of you must have noticed during the COVID time, right towards the end of that year, which was March 2020, we had this lockdown. And most of us know that 30, 31, and 30 and 31, and sometimes 1st of April, all of us go and do a stock take. Many of us were not able to go and do a stock take because there was a travel ban. There were nobody moving here and there. So the important thing was people managed how to do stock takes even virtually. There were people on the ground. There were people on video. They were asking certain things to be verified. So a lot of thought process went into even auditors having a mindset different from the traditional mindset. Had that own traditional mindset been there, we would not have been in a position to handle the year-end audits of March 2020 or March 2021. During both these periods, there were severe restrictions or lockdowns, which impacted the way the auditors could conduct their business. So this is something which we as auditing fraternity have learned the new ways of auditing. And I will pick up some of the examples in the subsequent slide, but this is what has impacted in the last 2-3 years. This has taught us that this is the new way of life. You have to deal with it. So going forward, what are the challenges which the auditor is facing today in terms of financial data? So if I take on the right-hand side and I will come to the left-hand side, data availability and accuracy. I'm sure most of you have heard about the concept of gaming. Now, gaming in the not the truest sense of gaming, because all of us know how online games can be played. But gaming in another way, because there is another name to that, people are able to game the data. What I mean by game the data, think of any of us who wanting to go and see a movie. Now, or let's say we want to go to a restaurant and eat food. The first thing most of us end up doing today, either on a Zomato, Swiggy, or any other app which gives the rating, I go and see the rating first. Is the rating of that particular restaurant very good, or the movie very good? Once the rating is seen, I start thinking that, okay, this appears to be that there are many customers who have gone here. They have given me they have given a good rating. This should be a good data. This should be a good data point for me to rely on that, because it is now a lot of third party are doing this data. And basis on that, I decide to go to a particular restaurant, or I decide to go to a movie. Now, the conmen, we must have all seen the Jamtara thing on Netflix. The conmen have realized that, okay, you if you have to influence the individual or the customers, there is a particular way to influence, because they are seeing certain data points we have to influence. So what happens in many cases, which are fraudulent companies, they go and make sure that their rating is higher by using robots who will go and keep putting the likes. So there will be multiple likes. Automatically, the rating will go up, and you feel that, hey, this particular restaurant or movie is great, and then you go and this. I'm just giving you example of these two. There could be multiple examples. Basis that you go and visit that restaurant, or take you go and see the movie. So it's important that with this kind of a background, you involve the right set of skills within your auditing profession to make sure that the data which is being made available to you, is it really accurate, or is it gamed, or is it fraudulated, or is it manipulated? So you why this is important? Because basis that data, now everything is all about data. Data is now considered to be the new oil, because oil is a very expensive natural resource, as you know. Now, data is considered to be the new oil. Now, because of this focus on data, you need to have the right skill set within your auditing team to make sure that this data which is being made available to you is sacrosanct. Nobody has gamed this data. So that's your data availability and accuracy, apart from the financial data, which all of us know. Now, another important thing is there is a focus on book closure process. All of us know, for a listed company, and most of these large technology companies which I'm talking about are all large listed companies. They want to publish their results within 10 days, 15 days at the end of the quarter. The speed at which they are able to publish their results, it pushes the auditor to also be ready, not only check the book closure process and their robustness, but also to make sure that whatever results are being published have been thoroughly checked and audited. Now, this is where a lot leveraging key auditing techniques in terms of making sure that the book closure process is thoroughly done also becomes important, because this is why, if the accounting is wrong, obviously the numbers which we will be reporting also will be wrong. What are the process flow documents? What are the new age digital tools which they are using? The new change in people, the lesser focus on manual data, the financial data which is outside of ERP system, data standardization and control, because there will be a lot of data which is sitting in ERP system, outside ERP system. There's a various challenges which or headwinds which the accounting profession faces. Now, in relation to this, the auditor will also start facing challenges. What are the challenges? I spoke about data availability, data accuracy, and completeness, the entire example I gave you. Now, another challenge which we always keep seeing is no data standardization and control, making it difficult for the auditors to begin their procedures. What do I mean by that? Important thing, we struggle in reconciliation. Our biggest challenge as an auditor or even the accounting team is reconciliation. I have a number which is coming from my MIS system. That number doesn't match with my financial system. The first thing as an auditor will ask is, why is there a number difference? Are you having a separate books and records? Are you having separate set of KPIs which you are measuring, which is not equal to what I see? Then second thing is, this is one way of seeing the reconciliation. The second challenge which you'll notice is also the fact that many of this data may be coming from different subsystems. We notice that there are the larger companies may be using integrated ERP, but not everything may be integrated. I may have a sales pipeline data coming from my Salesforce or a Microsoft CRM or any other CRM software. I may have the invoice data coming from my, let's say, the GST database. So when I start trying to compare and contrast, I find it difficult. What is the common VLOOKUP formula I need to put so that I am comfortable with the numbers which are getting presented? That's when the challenge arises to the auditor to say, how do I audit this? Because it is so difficult to sit and match. And I cannot be sitting account reconciliation when my focus has to be quality of what is there inside the report which they have given, and also doing a lot of analytics. If we get lost in this reconciliation, there'll be no time to report. So that's another big challenge from an auditor point of view. Lack of standardization and control. Important thing today, as you know, all of us for the large companies, especially in the context of tech companies, all of them are required to report on the internal control. Now that is where it's not only the auditing on the numbers, but also internal control matters. It cannot be a tick in the box exercise. You have to do a thorough procedures of doing a control testing. My subsequent slides will focus on what a control testing, how should you evaluate control testing, when should you move away from control testing to a substantive testing, or a mix of these two. I'll focus on that piece as well. That's another one. Now, if you notice the next bullet, insufficient accounting tools and technology, which results in significant amount of manual data being received by auditors. Think of Ind AS 116. All of us know how the companies have implemented. In many times, we notice that there may not be a software to deal with this particular standard. All that is being done by or many of these large companies. Maybe they run it out of Excel. Now, if there are multiple thousands of lease contracts which they have entered into. For us, in the past, when we thought of lease contract, we thought of building as a lease contract. But today, all of you know, even your laptops are on leases, even your servers are on leases. Forget about all this. Even your printers, which used to be bought in the past by companies, now are on lease contracts. Every item is moving into a lease contract, including your office. Forget about office space, but the office desk itself, because of companies like WeWork and all, they give you a combined contract of an office space, including the desk, including the data connectivity as one bundle contract. So all of this will have to be evaluated from a leasing standard. Now, if you do not have enough accounting tools or technology to deal with this complex standards, there is always a possibility that Excel or Excel spreadsheet may go wrong because it's all humanly calculated. One formula mistake, which you cannot sit and verify every column, every row item, can have a significant impact on your balance sheet. So this is also another big challenge which the auditor face. How do you verify things which are not automated? Limited financial data, which makes it difficult for auditors to perform testing and assess trends over time. If I do not get enough data at a detailed level, for me to run an analytics and reduce the level of substantive testing I have to do, if it is not available in the form and format which I want to do, then also it gives me a bigger challenge. Another one, which came out of largely because of the great resignation which I spoke about, is the fact that we have seen a churn within the finance accounting FP&A function. Now that leads to a fact that the newer set of team members may have a skill set gap initially. They may pick up in the future because all of them are chartered accountants. It's just a matter of time before they start picking up. But the question is, during that time when they are learning, how do you deal with it? And after they learn, if they start getting better offers when they move out, then again, the auditing and the finance team will have a struggle in terms of providing data and verifying data. These are all the challenges which we have seen in the last 2 years arising because of COVID, arising because of great resignation, arising because there is more and more focus on digitization and less focus on the people-driven organization. Now, if I give this context, now that I've set the context, as I mentioned, I'll break this conversation into two parts. One is how to audit, what are the process to be established before you get to an audit. And this will be not only relevant for IT companies, but for other companies as well. But my focus will be more largely on the IT companies because our today's conversation is all about IT companies. All of them are in a very, very mature level. Many of them may be maturing. Many of them may be new, but all of them have learned through the last 3 decades or so, since 4 decades rather, since they have established themselves. So the way the auditing has to be conducted, that is what I will focus in the first portion of my presentation. Subsequently, as I mentioned, I will pick up on the specific topics. Now, if we split the first portion into 4 buckets. First is how to do an audit planning. What should be your auditing methodology and process? That should be defined, and that should be defined based on the type of company you're dealing with. Most of these companies are large listed companies, public interest entities, PIEs, as we call it in many places. How do you deal with public interest entities? Once you are able to set up, then you have to define what are the auditing procedures which you will do. Before you set up the auditing procedures, you have to also look at the risk classification of all these various transactions which the companies do, and the control framework. Once the identification of risk and the process will be established, the second process is to look at what controls the company has established. Are those controls really operating? Are those controls merely paper controls? Are we talking about a scenario where, for the sake of some compliance, the company does some control testing or establishes certain controls, but in theory, but in actual practice, none of those controls are being followed? Then there is a classic case of design deficiency, where it is not designed to control certain things, or even if it is designed properly and it is not operated properly because the set of team members who have come in, they're all new and they don't know how to operate a control. There could be a scenario of operating ineffectiveness or operating deficiency. But we'll talk about this in a bit. Once these two are established, you have to do a control testing, after that substantive testing, and then whatever is the outcome of all these, you will communicate with the management or those charged with governance. So if you notice, the way I have structured this is to do a thorough audit planning for any company, but more focused on the IT companies. And we'll go through that process one by one. Now, as I mentioned, when you start evaluating an audit, first thing is do a risk assessment, because it's very important to identify what is the risk which we carry in that particular company. Is there a reputation risk which the company is carrying? Are there issues from a regulatory point of view? What are the other things which we believe from that industry or from that sector or from that company we have gathered information about the company? What are the things which we should bake into our risk assessment? Once for that risk assessment, you need to find out what should be your audit evidence. Now, when you are evaluating, and throughout this theme, you will notice that I have kept it extremely limited in terms of the text, at least the initial theory part. Everything I've done it like a flow chart so that it becomes easy for all of you to follow. Otherwise, it's auditing as a standard may become extremely boring for a lot of us because it is too much of text. Here I have tried making it interactive by keeping most of them, at least in the first part, more flowchart driven rather than the text driven. So in the auditing evidence, two things which we evaluate. One is sufficiency of the audit evidence and appropriateness. What is sufficiency? How much is the audit evidence we require for us to be comfortable that we can opine on this particular, let's say, the company or particular item or particular scope of transaction, class of transaction. Okay, so each of them will be evaluated under sufficiency. From an appropriateness point of view, then we go, what is appropriate? How strong is the evidence? Within that, what is it relevant? And can I rely? How can I rely? Should I only rely on internal documentation? Should I rely on external documentation alone? Or should I rely on a combination of external plus internal? We'll talk about it. So this is where first is to determine the appropriateness of the audit evidence. Once you are able to establish this, then if you notice there, we spoke about reliability. So I will pick the example of reliability here. Now, if you notice reliability, each of this flowchart will give you some indication of what is more reliable and what is less reliable. And there are some examples here. Evidence from from a source internal to the accounting function. This is less reliable. More reliable is evidence from a knowledgeable, independent source outside of the entity. If I take an example, classic example which all of us know is if there is a actuarial valuation on a leave encashment, which is let's say which is calculated. Let's say it is unfunded leave. It is not a very difficult calculation. If the company gives you an internal computation, you will feel less comfortable about it than an actuary. But because all of us know how to use an actuary, if I take another example, which will give you a good comfort. Imagine that you are doing an impairment testing. Okay, you already concluded that there are impairment indicators, and you want to do an impairment testing. For that testing, if I give you a cash flow information, which is largely driven by the internal finance and accounting function, the first thing you will say is, hey, this is good evidence, not that it is bad evidence, just that I may have to do a lot more procedures to get to a comfort that this particular evidence provided by the internal finance and accounting team is strong enough for me to document. But if the company goes ahead and says, "Hey, don't worry, Mr. Auditor, Mr. or Miss Auditor, I should be careful with the diversity here. Hey, Auditor, you need more evidence. I'll give you a valuation report, an impairment assessment valuation report by a third-party external expert advisor whom I have engaged. So please have a look at this. If this evidence is provided to us, we as auditors will say, hey, this looks much more objective, much more evidential, because somebody who's preparing this report, he or she, that organization will have their own checks and balances, will have their quality and risk management in place. And if something goes wrong, we can always question them. And that evidence is easy to verify because it does not have any prejudiced or biased thing from the accounting point of view. So this is one example of focusing more on external evidence and less on the internal evidence. Similarly, from a reliability, information from a system with ineffective controls. Take an example, some legacy software does not have control in place. What do you mean by does not have control in place? If I delete a particular entry, there is no record that Darshan Verma has deleted that entry. If somebody has gone in and in the backend, they have changed the system date, there is no record. So if you have this kind of a accounting system or any system for that matter, then your IT team, which is helping you in the IT audit of this company, would tell you, hey, auditor, please don't rely on the system because the system is very ineffective. You can easily go back and modify. I don't want to use the term manipulate. They can easily modify, and there is no audit trail available for these modification. Or even if it is available, it's not sufficient for us to go and verify anything. So then immediately the response to this non-reliability is the fact that you have to start doing more testing. You will start asking for more samples. You will asking for more other evidence. That is where the challenge arises from an internal system which is ineffective. But if the system is robust and your system auditor, who's part of your audit team, is able to give you a comfort that everything in the system cannot be is working fine, cannot be tampered with, you can rely, then the level of testing automatically comes down because there is a reliance on the automated controls. Same thing, third one, a great example. Our biggest fraud in India came out because of this. Evidence obtained indirectly. That means you will sit with a company personnel and ask for some evidence, be it confirmation, be it any other evidence. But when it comes to evidence obtained directly by the auditor, which is a classic case, if I give you this example, it's a confirmation, your bank confirmation, your account receivable, account payable confirmation. If you run the process and you get those information directly from these parties, then the level of confidence or the reliability on that evidence is much higher than the same information being provided indirectly by the company. It's not that it is any different, but there's always a preference over external evidence versus internal evidence. And we have seen that a decade ago when the biggest fraud happened in the India Inc., the biggest challenge was that there was challenges in terms of confirmation. Photocopied or digital information without appropriate custodial controls. Now, again, this is also that was in the same example. There was also a lot of color photocopies or color copies of those confirmations which were provided, which appeared genuine. We missed it or whatever happened in that case. That challenge will always be aggravated if you're relying on internal evidence. Hey, had this been original documents, then the evidence would be much higher. So if you notice here, the focus is, if you want a reliability of your evidence, whatever evidence you're gathering, the focus is try to get as much as external evidence, third-party unbiased evidence, so that it can support your audit. If it is not possible, then you will have to go down the path of your internal evidence, but then your level of testing, the level of other controls around it will only go up in terms of the efforts. Okay, let me go to in terms of sufficiency. If you remember, there was relevance, then there was sufficiency of the internal the evidence. Once we have defined the risk, I'll gather the fact, perform my analysis, make the judgment. After doing all this, I have to document the analysis. Why this documentation, audit documentation, is gaining more and more importance, it was always there, not that it was never there in terms of documentation, but because there is more and more regulatory overdrive, and now that you know, there is also there was always FRRB, there was always the review committees of the ICI. Now there is NFRA as well. Everybody will come back post you conducting an audit. The first thing they will ask is, show me the document. Okay, because your document should actually meet the re-performance standard. If somebody, he or she, is able to come and perform this entire step, they should more or less get to the same conclusion, not exactly the same conclusion or a similar conclusion of what you've got to, because your documentation should be so robust that they will be able to gather that same conclusion by doing an audit. So that's the most important thing. So if you notice here, the slide would give you once you are able to make an assessment of risk of material misstatement, because something which is not material doesn't come into this picture at all. But once we believe that something is material, identify that risk, gather the fact. More importantly, that facts are to be gathered are external, only then, if not possible, then internal. Then perform your analysis. This is what I was telling you, that you'll have to have enough and more time to perform this analysis. If you're starting to gather facts and you're only sitting and reconciling, and you are not able to do step 3 and step 4, and step 5 you don't have time to document, you are in a biggest challenge, because then anybody can come and say that you have not performed your duties properly, and you issued an auditing opinion even without performing all the other steps, because there was very limited time which was made available to you, and you were struggling with a lot of data. So it's important that you are able to do all these and able to get to a auditing opinion. Here on the right hand side, I kept highlighting certain things. I spoke about IT team being involved when you are getting the audit done on an IT technology, especially in these IT companies. There is a lot more push on the auditors to say, we are automated. Can you automate your auditing procedures? Don't come and ask some of these basic questions. All these controls are available within our system. Go and check it yourself. That's how they will push you. Because of this, you need to have the right skill set. Beyond auditing team members, you need to have people from tax background. You need to have people from a system background. You need to have people from a forensic background. All of these are specialists who will come and contribute to your audit to make sure that the audit is able to take a 360-degree view of the company, and you are able to issue an auditing opinion. And then, so if you notice all of this, there is also professional skepticism. We always have to keep asking why and how things are happening, because then you're just not making certain conclusions based on certain interviews. You're questioning also, which is one of the important things from an auditor point of view, is to always ask a leading question. When I started my career about 23, 24 years ago, the first thing which my principal taught me, Darshan, don't ask a question to conclude, because then you're framing a question to make sure that you don't need further responses from them. Ask a question so that it can lead to further inquiries or further information from your client. If you try focusing on getting an answer just so that you can document and move forward, then you will miss the big picture. Always go with that professional skepticism so that you can have an inquiry or an observable mind, which will keep asking, hey, what happens if this is not correct? What happens if this is not correct? So through that professional skepticism of yours, you will be able to gather enough and more evidence so that it will help you conclude on any topic which you're dealing with. Which means that if there are fraudulent areas, your inquiry will be that much more detailed. Moving forward, now that we spoke about how the risk assessment should happen, what should be the level of auditing evidence, reliability, the sufficiency of audit evidence. Another thing which I had highlighted is to focus on controls, right? Because all of us know that we as auditors are supposed to issue an integrated audit report. One is a report on the internal control. Second is a report on the normal financial statement. Obviously, embedded within that, or a subset within that main report, is also CARO, where we issue a specific report on certain matters which are highlighted in the CARO report. Now, the first portion, which is the internal control, auditors are now required to issue audit report on the internal control framework. So if you notice here, from an evidence point of view, from the left-hand side, there is certain comfort you will get from testing of controls. And what are those controls? How to verify? We'll come to it in a bit. But as you progress, if the controls will stop somewhere, you need to do substantive testing. There is no replacement to do substantive testing. So if you notice this thing, based on your level of confidence, the level of substantive procedures will only keep going up. And based on the control evaluation, the number of samples to be tested also will come down. If there is very limited controls, which we spoke about in the previous slide, if the company does not operate in a very good control environment, then the level of testing and assurance from substantive procedures is your, if I have to demystify and use a very layman language, it's testing of your actual data, your invoices, your purchase orders, those kind of stuff. Those will require a lot more depth compared to what you can rely on controls. The better the controls, the number of samples will only come down. If you see the more persuasive evidence, the more testing it is required. So measuring the appropriateness of evidence. If there is little evidence, information, so little will also be connected to the indirect information. Okay, so the more direct information I get, the more persuasive the evidence will be. If you remember the audit evidence, there were some examples. So evidence is all about internal versus external. We spoke about it. The more and more reliance is on the external evidence. Second thing, strength of evidence type, inquiry versus confirmation. So if you just inquire and document, that may be a good evidence. It may come to little or some, but if you get to a confirmation, it will give you a persuasive evidence. So it's important for you to evaluate what kind of evidence you are trying to gather. So if I take the example of, let's say, in the technology company, let's say there is a large contract which one of the technology companies which you're auditing have announced. They'll say, we have entered into $100 million contract for 5 years with ABC Inc. in the US. Now that's a big announcement. You will notice that announcement sits on their shareholders website in the investor relations section. They also go and announce, because it's such a large win, they would want to go and announce in the stock exchange also. So the stock exchange reporting will also include this big announcement. Now, suddenly you'll say, okay, this is a great announcement. How do I as auditor, because this is talking about sales contract, how do I as auditors verify this? Should I just go and verify the press release? Answer is no, because press release is just a subset of that particular information. We as auditors will have to verify the sales contract which they have entered into. More importantly, it's the original document which needs to be verified. That will give you more evidence, persuasive or corroborative, saying that, hey, this announcement had a proper backup. It was not just somebody just throwing based on some email, an announcement came through. So an external evidence comes through. Another important thing is, how do I know that this particular contract which I've entered into it and I've started servicing is really existing? So what do? I do a account receivable confirmation. I send a confirmation to the customer. Hey, customer, we have a balance of so much outstanding from you to us, or this is a particular invoice number which is outstanding from you to us. Please confirm directly to the auditors. Once the customer says, yes, I owe this amount to my to this vendor who is XYZ India Limited, we as auditors get a comfort saying that, hey, this is not only the contract is existing, but also the fact that this is being serviced by this particular IT company also exists. That's the comfort we will get if we are able to get more and more external evidence or confirmation from outside. Moving on. Now, in terms of, if you notice the way certain assertions happen, this is more identifying than assessing the risk. There's an income statement risk, there's a balance sheet risk. Okay. Now, what you see on the right-hand side is called financial statement assertion. A balance sheet will have certain assertions, an income statement will have certain assertion. For income statement, we have occurrence, completeness, measurement, presentation, and disclosure. For balance sheet, there is existence, completeness, valuation, rights and obligation, presentation, and disclosure. Now, all this will only happen once. So the balance sheet of the last period, plus you start recording both income statement transaction and balance sheet transaction, initiation, recording, processing, and reporting. These are the various class of transaction which gets into it. Whatever we'll pick certain class of transaction as we go. This is under each class of transaction, all this will happen. So for one class of transaction, how it is done, and even for disclosure, mind you, if you get something wrong in disclosure, under the Ind AS framework, Ind AS 8, it says that you are required to do a restatement. It is no longer sufficient to say that my primary financial statement, which is balance sheet, income statement, statement of changes in equity, etc., are okay. But if my disclosure says that, in fact, if there are wrong disclosures, let's say on Ind AS 115 or 116, it could lead to a restatement. So you need to have a comfort that the company is having robust procedures and process, not only for class of transaction, but also for significant disclosure process. Now, what are the components of internal control? ELC stand for entity level control. TLC stands for transaction or process level controls. Control environment is largely at entity level. Risk assessment process, you need to evaluate as an auditor how the risk assessment is being done by the company, because they may have a enterprise risk management framework. All these large companies, tech companies, have a good enterprise risk management. I'll give you a simple example. How many of you have gone back and assessed what is the risk of doing a business with business in Ukraine? If I have exposure in Ukraine, because there is war which was going on for the last 1 year, what is the company's risk assessment process in terms of exposure of doing business in Ukraine? So that's a question which will be asked to auditors. Did you check how the company is evaluating? If you've checked it, how did you get a comfort saying that their evaluation process, their assessment, their conclusion is well documented, and you are happy with that documentation, and you have managed to do a reperformance or get comfortable either through inquiry or confirmation that this process works? So this is again an important thing which we need to be careful or mindful of when we are doing the audit. Process to monitor the system and internal control. I did highlight this in a couple of slides ago. Is this more a tick in the box kind of exercise, or is it more really being lived within the organization? The company truly believes in internal control. There is proper monitoring. The audit committee, more importantly, because all these things get reported back to audit committee. Audit committee is seriously having a look at the outcomes of all these testing and challenging the testers or the internal control department to give them comfort, saying that the internal control over financial reporting is really operating very well from an auditor point of view. But more importantly, from a company wide, there is internal financial controls which has broader controls. All of them are operating. So that's very important. The information communication control activities, these are all the various elements or the internal components of your internal control. Now, how do I look at the categories of control, and what should be my evaluation? Why I bring this important element? So I'll go from left to right. It's important because what you'll see in the large tech companies, this is how the environment will be. They have a fantastic operating system. They have good databases. Then they also have a very good IT applications. They do, because they themselves are into IT, they would have a very robust level. So and then there will be automatically some application controls, which is not human driven. Then there will be IT dependent manual controls, and they will want to keep their entire manual controls as minimal as possible. Because if there is a robust system here, this has to anyway be a very less number. So if you notice, I have ITDM, which is IT dependent manual control. I have application controls. I have the entire manual controls. These are the three categories which I am here. At this level, I need to know, hey, whether these controls are being operated by individuals or by systems where there is no segregation of duty conflict. If there is segregation of duty conflict where the maker is also the checker, then there is no meaning to any of these controls. You can say there is a control operating but has no meaning. So very important to ensure that the SODs, or the segregation of duty conflicts, do not exist, and that's resolved. And then at an entity level, we spoke in the previous slide, there is adequate control and focus to make sure that these control operate and there are no management override of any of these controls. The biggest challenge is if the management overrides all pervasive controls, then you will have a bigger challenge in terms of auditing. So this is from a IT landscape point of view, how you look at controls, or even non-IT related, will all go into manual. So if you notice here, controls within each class of transaction, revenue, purchases, sales, fixed assets, think of anything, all of them will come here. What is the objective? It should prevent the misstatement. That's very important, because otherwise there is no point of deploying a control if it keeps leading to misstatement. Then there is no meaning to that control. If it is not preventing, it should at least detect and correct it. They should be both detect and protect, detect control, and proactively a prevent control as well. So that's important. Support the continued functioning of automated aspects of prevent and detect and control, correct controls. So under all these larger buckets, so if you notice here, we spoke about it. Automated is application controls. There is a split between, because there is some portion of IT and some portion of manual. It is called IT dependent manual controls, and there is manual controls. So this is the whatever 360-degree view of all the focus on controls. Now, if I move forward, when you start looking at relevance of controls selected for testing, identify whether those will have a significant risk. This is all again risk evaluation. Basis that risk evaluation of high versus low. There could be low risk control, there will be high risk control. Basis that view, you'll have to definitely test the high risk control, not that low risk control need not be tested. You will have to make sure that the management has also thoroughly tested this. You have to evaluate these controls, link it back to your risk assessment. Basis that the control needs to be tested. Not all controls are tested, only key controls are tested normally. So you'll have to evaluate and conclude what are the controls which are key. And if there's a control failure, and whether it is operating effectively, or if there is, let's say, a lot of changes in the department, then are there segregation of duty conflict? Are there any challenges? All of that has to be considered when you start doing the control testing. Now, how do you do the control testing? The question is, any control exception discovered? No, then rely on controls as you start testing. If you identify any control exception, first identify those control exception. What should be your audit response? Should I go from here to here, or should I go flow down? Conclude on the operating effectiveness of the control. If it is designed properly but not operating properly. Let me give you an example. Let's say there is a simple example, not to make it too complicated. For every bank reconciliation which is prepared by my FP&A team, the CFO does a review on a monthly basis and signs saying that this particular control is, or this particular reconciliation is done fine. So this is the design principle. Okay, the design is on a monthly basis. There is a preparation of bank reconciliation by the financial accounting team. First level reviewer will be the head of accounting. Second level reviewer will be CFO. Let's say this is the design of that particular control. Now there is no problem in design, because when you tested the design, you felt comfortable. Yeah, there is a proper 4I principle. There's a maker, there's a checker. So there is a proper, and within that checker, there are two different checkers who are making the verification. So you feel comfortable. So then you start going down and say, hey, while this is designed properly, is it really operating? Is the head of accounting and or the CFO really verifying those bank reconciliation? And you pick examples. You ask the client to hey, give me the April month, give me the July month, or let's say give me the December month bank reconciliation. You notice that the preparer has prepared all the reconciliation. Either the head of accounting or the CFO, nobody has bothered to see it, because it has become very routine and they don't believe that they need to see it, or they don't have enough time to sit and see and review it. Now, suddenly then you realize, hey, while the control is designed properly, when we did the control testing, we identified these exceptions are there, that there is no review by the head of accounting or head of or the CFO. And then we say, I don't think this is operating effectively, because of which I will not rely on controls. If you get to an answer, no, this is operating effectively, only then you rely on controls. If it is not rely on controls, then automatically a couple of minutes back, I spoke about focus on substantive testing, where it was moving from less to high. Then if the control reliance is moving lesser, substantive testing will only go up. So it's important for all of us as auditors to make sure that, because we are supposed to opine on the controls operating on the financial statements, on the ICOFR, a thorough testing is done, a proper testing strategy is applied, the guidance note on ICOFR has to be applied, and basis that you'll have to get to an answer in terms of whether you will give a unqualified opinion or unmodified opinion on the controls operating in the company. Please keep in mind, the board of directors are also supposed to comment on the internal controls operating in the company, and that reliance is placed based on what the management is tested and given the comfort to the audit committee and the board of directors. So I'll move forward now. Another big element is fraud risk. Okay. Now, why fraud risk is important? I spoke about the gaming of that particular platform, right? Whether it is the movies or the restaurant ratings, there are more and more things, or more and more ways to commit a fraud today. People are very smart. People have now got the access to technology. You must have heard about thousands of frauds. Many of you, while I'm digressing a bit, I'll take a minute to talk about it. Many of you must have heard about the Paytm fraud, right? What was Paytm fraud? Many of us noticed that when I go to when the shopkeeper is asking me to pay an amount, and he will show me a scanner, I scan it and show them that I have paid. Then the shopkeeper will say, "Sorry, I have not received." We say, "No, no problem. I have already paid it. It may, because of your network issue, it may come to you in 5 minutes." But what this fraudster was trying to actually do is, they have created an app which will look like a Paytm app, and you have to type in the name of the company which you are making the payment, and also put the money. And then if you show, it will not deduct any money from your bank account or your wallet. It will only show that they have made a payment. And the other recipient will think that, okay, it is appearing in the phone screen of me where I'm making the payment. It may be a problem of connectivity, which the other person is not receiving. But later on, they realize this is actually a fraudster. He or she never paid the money. They were just creating an app to show that the money was paid, and we were getting fooled that the money was coming through. This is all, as I said, the people are very ingenious. They come up with innovative ideas to commit a fraud, and that's where, if there is a material risk of material misstatement due to fraud, then it's a bigger challenge for you as auditors, because if you don't identify that, then the question keeps arising: hey, how did the auditor miss it? A common man doesn't understand the fact that we as auditors will have to see millions of transactions with very limited time, and we can't be auditing all millions of transactions. We do an audit of a sample, and the sample, we verify controls first, then we do an analytic, then we do substantive, and then we get a comfort. So it's important to make sure that the areas which we are seeing are all pervasive. Is there a fraud associated with this company or this particular transaction or this particular class of transaction? For that to happen, you have to do, as I mentioned, one of the other professionals within the auditing team you should definitely consider having is a forensic expert. Why do I say this? I say this because each of us may be a company law expert or a tax expert or an auditing expert. We may or may not be a good forensic expert, because the way the forensic professionals see a document or a particular matter is completely different, because they are trained to see it that way. We are not fully trained to see it that way. So it does not harm you to have those kind of additional experts within your auditing team who will come and do the testing from a forensic angle to give you comfort. Hey, auditor, I think I've gone through whatever is required from a fraud inquiry point of view, from a fraud testing point of view. Basis various checks which we have conducted, we believe that you can go ahead and rely on this particular class of transaction or a particular account or an assertion or the financial statement as a whole. You can rely basis whatever testing they have conducted. So very important aspect to your audit, to make sure that the fraud risk assessment is conducted. It's a very busy slide. Apart from, compared to my previous slides, you will notice that this is an extremely busy slide. So I will try picking some examples from here and talking you through. What this is talking about is a risk of material misstatement coming through journal entries. All of you must have heard about last minute journal entries, which can cause a significant change in the balance sheet of your profit and loss account. Post closing adjustments, journal entries and other adjustments made to record transaction outside the normal course of business. Okay, midnight entries, entries on weekends, entries on public holidays, entries being posted by senior FP&A or accounting team. So things of this nature, you have to do a lot more detailed inquiries. and you have to pull out that information, do a thorough analysis, and then ascertain what is the reason why these entries are getting posted. Was there a management incentive to manipulate the earnings or misappropriate assets? That is a fraud angle, right? Because please keep in mind that based on performance of that quarter, most of the IT companies also issue bonuses. Unlike many other traditional companies, where the bonus is given at the year end, in these companies they also do a quarterly evaluation of performance. Basis that you may have an incentive or a disincentive to show a higher earnings or a lower earnings. So it is important for us to see what are those post-closing entries or close to the year-end adjustments. Why these are important? You will notice that once they start seeing the first cut profit and loss account, they may realize that, oh, this is not sufficient. I will not meet my budgets. I will not meet my forecast. I will not meet my goals. Because of this, I want to go and make some adjustments. That's where these adjustments are done closer to the year end or post closing after the review by the CEO, CFO, they will make those adjustments. Or this will be done outside the course of normal business. As I mentioned, some senior folk will come and sit and do this because those numbers could be so significant that a junior account executive may not be in a position to post those entries. So it's a word of caution that all of you, when you're auditing, please make sure that these kind of journal entries are picked out in your testing, because this will give you comfort whether there is a potential fraudulent transaction or there is none. Okay. So this will also help you modify your auditing strategy, because if you notice that, okay, any of these are present, then start looking at doing a detailed audit. It will be control based. If it is not, then it will move to substantive. So the idea behind this slide is evaluate and respond to if there is a potential fraud risk existing in the audit which you are conducting. Now, we spoke about this a couple of slides earlier. If you noticed, I spoke about both the class of transaction and disclosures, initiation, recording, processing, and reporting. Reporting in GL will be either through subledger or general ledger. Then there will be processing of journal entries, financial statement preparation, along with related disclosure. All of this will happen, and the financial statements will be issued with an audit opinion. So this is where the FSCP, which is a financial statement close process, kicks in. We'll speak about it in a bit. Now, this is how you should look at the class of transaction, which is being dealt with. So if I take one of the things in terms of disclosures, I mentioned to you in the beginning that it's not only primary financial statement which we have to get it right, but also the disclosures. If you get a wrong disclosure in Ind AS 115, which is revenue from customer contracts, so there could be a situation that those numbers are completely incorrect. They are material enough. Though you may argue, and the client may argue, when I say you means the client may argue that nothing is changing in my P&L, nothing is changing in my balance sheet, just my disclosure is wrong. But the way Ind AS 115 is written and also read with Ind AS 8, it says that if you have got something wrong, including a disclosure, and it is material enough, obviously all accounting standards are on for material transaction, then you have to go back and restate what you have published. So when you look at significant disclosure, you have to make sure that you have to audit those disclosures, the notes to accounts data, as we call it. There also, it's important to see whether that notes data is coming through certain technology or tools. And that is where you can place reliance on the controls. If you cannot place reliance on controls because it is all manual, because you concluded that it is ineffective, you have no other choice but to start doing substantive. Substantive means that you will start verifying that in more detail. You will ask for more samples. This only, as I said, adds to the entire labor element in the audit, and also the time element. It only goes up in terms of the time we take to complete an audit. So this was all about evaluating, assessing the risk, planning for an audit, doing a control testing. Then once you are able to conclude on control testing, which also includes the risk of fraud, and after that the substantive testing, a couple of other things which are quick reminders from an auditing point of view is going concern. Why going concern is important these days? Going concern is important these days because you never know what was a very healthy company 2 quarters ago suddenly becomes bankrupt these days, because They could have a wrong risk management strategy, or they may have done certain investments thinking that this will give pay off significantly, that may have gone bust, or the company may have significantly invested in a new product. Even IT companies, the product companies are the ones like your SAPs of the world or Microsoft. They may have worked on a product, and by the time they are able to launch that product, a competitor immediately comes out and then kills the entire business. All of you must have heard about this Chat GPT, right? It's a newer kid in the block. And I was testing that Chat GPT, and I asked a question. Hey, Chat GPT, can you can you write a story for my 10-year-old daughter? So then automatically it started writing a story for my 10-year-old daughter. It has data which is slightly dated. It has data up to 2021. After that, it is not fully updated. So it just pulled out a story from somewhere in the web and started writing a 3-page story. So I was stunned. Okay, I said, okay, for a 10-year-old kid, for a daughter, it has to come out with a story which should be more appropriate. Automatically, I started typing. Then think of it, how this had an impact on the big boys. The first thing which everybody started talking was, this is a Google killer. This is what they started talking. I don't know whether it will be or it will not be, but this is how they started talking. A new technology comes and says that, okay, now you don't need to go for a search engine. Don't search for anything. Type anything here in my Chat GPT. I will give you all answers. The moment that came, everybody said, hey, what will happen to Google? How will they react to this? Can they react to this? The second thing which you noticed was Microsoft went and bought 49% of this company. So suddenly, all the capabilities of this particular platform is available for Microsoft. Now, so is it trying to build a search engine? What is it trying to do? Will it start reducing and have an impact on Google? We don't know. But the point I'm trying to make is there are things which constantly keep changing. And the reason I gave you this example was in the tech space. This could happen in other space as well. What you'll have to constantly keep ascertaining the entity's ability to continue in the business in the foreseeable future, because you don't know what changes are happening. And especially if you're not very well connected with what is happening in the industry, because you're only focused on only auditing and only on the financial statements, you may lose the fact that there are a lot of things around which are happening which has a significant impact on the entity. So please keep a close eye on the going concern, understand it carefully. If the companies has customers has exposures in, let's say, as an example, I gave you Ukraine or Argentina, which is now in hyperinflation. Look at that carefully. It's important for you to understand that each of those could have a significant bearing on your going concern. This is a quick reminder, because when you're auditing these companies, it's not easy because they may have different verticals. Each of the verticals could be exposed to certain thing. And if you do not have a robust system of making that assessment and also doing inquiries with the senior management, you will never get to know whether there are challenges within the business. So that's a quick reminder, because we always assume that the company is profitable, so going concern is never an issue. That's not the simple assumption or documentation. You have to ascertain this and document that going concern as a basis for accounting is still appropriate, and you are still able to produce the financial statement on a going concern basis and not a liquidation basis accounting. Okay, now I will move forward. In terms of auditing methodology and process, obtaining audit evidence, we spoke about relevance, reliability, sampling, etc. This gives you a quick summary of what you should do. Again, slightly detailed slide, but if you notice, obtaining audit evidence, do you want to select 100% because it's very risky and there is limited control evidence? Sampling, within that specific items based on either amount or value or risk associated. Then you can go down to whether you can do a statistical sampling, judgmental sampling. So various process in terms of determining the audit evidence you will collect. And as I mentioned, important thing here is once you collect the evidence, once you test it, document all of that and document the process in which you got to that answer. Okay, so same thing continued here. A systematic sample, random sample, even haphazard is also a sampling methodology, as all of you know. So that also is again, it all rolls up into the judgmental sampling. So you can go ahead and do this. So this will, and basis that, as I said, kindly document whatever you've carried out. A couple of more slides and I will end the auditing process of it, and then I'll pick up some examples of how you should deal with specifically from IT industry point of view. If I take the business cycle of IT companies, they generate sales, which also gives them gross margin. It also gives them account receivable. Account receivables gets converted into cash. As in, once they collect the money, it gets converted into cash. So you will have to run a confirmation. You will have to run the collectibility credits, consider confirmation. You also have to do something called an ECL, expected credit loss, on this. So very important from an IT company point of view. They are into multiple sectors. They have customers who are in pharma, who are in oil and gas. There are also government customers. They also have customers cross-border. So one is collectability. What are the credits which they have exposed to? Confirmations, etc. All of them have to be, as an auditor, you have to look at this. Cash, you'll get the confirmation. Cash payments, whether it is payroll, selling, general admin expenditure. You also have to bake in the entire income tax element from an India context. If you notice, your 40A3 payment should be below a particular threshold. Are you running those things from a system point of view and identifying, are there potential breaking of those amounts into multiple amounts to breach the threshold? You have to look at all of that. Then there is purchases, which leads to accounts payable. Again, all of this will have to be, again, you'll have to run the confirmation because you're, again, I'm going from here to here. Cost of sales for a manufacturing company, cost of revenue for a IT company, cost of revenue in this case will be all your employee costs, significant employee costs, which is payroll, which will come and sit here. Inventory for IT company will be your unbilled reserves, which is sitting unbilled because the customer has still not confirmed that. So it is sitting in unbilled and that through purchases, accounts payable. So if you notice, this is all your general business cycle. And this business cycle will have transaction controls, will have entity level controls. So it's important for you to see all this and get that comfort saying that, okay, are there enough controls in place? Evaluate the controls, then sufficiency, acceptability of the evidences you get. Basis that you will do substantive testing. When you're doing the testing, certain things which you have to keep in mind, these are quick reminders: set an expectation, perform analysis, refine expectation. What does it mean? So if I know that basis my past 1 year, 2 year, 3 year experience of this IT company, I expect the payroll to be increased at 12% for year on year because they give an increment of 12%. So if I set the expectation and compare the run analysis, I should be able to see that my year on year payroll cost has increased by 12. If I get either an 8 or a 14, then I get to immediately have to see, hey, this is unusual. This is not in line with the expectation I've set because my 3-year history shows me 12, but this seems to be, there is something wrong that they have given only 8% increase, or there's something unusual that it is showing a 14% increase. That's when you start further disaggregating, identify where those exceptions are. It may be so that they have given a huge payroll hike just to meet the demand because there is great resignation. That was not something which we saw in the last 3 years. Identify this, investigate, including vouching of source document, understand the nature and cause. Then once you are comfortable, are these unusual items understood? If proper audit design was done, checking was done, and then we conclude that there is no exception and there is no misstatement. If there is, then we'll have to further investigate and identify the potential misstatement. A couple of other quick reminders: as your combined risk goes down, the variance threshold is lower. As it goes up, then you have to narrow the variance risk and start testing it thoroughly. So I'll skip this slide for a moment because I know we are already at 5:15. In the next 15-20 minutes, I need to close and I'll have to leave enough time for you to do a Q&A. So what you noticed in the last 1 hour or so was how to conduct an audit. Not that none of you knew it, you all knew it, just that in the context of how technologies companies have evolved, you have to conduct an audit slightly differently from a traditional auditing mindset. You have to involve more and more technology in the way you conduct an audit because there is tons of data and there is very limited time given by these companies, especially because they are listed and they want to publish the results at the earliest. So that's the auditing fundamentals or auditing 101 for what I just discussed. Now, there are some key topics in these IT companies or ITES companies which make it more complex when you're auditing. Why do I say that? And one example is a classic example of revenue recognition. All of you know they are driven by large contracts. All these large technology companies sign multi-year contracts. Each of those contracts are $1 million, $2 million, $150 million, $100 million. If you go and notice their investor relation website, you will see large deals announcement. They'll give you a list of large deals, how much they have signed, medium deals, small deals. Each of those deals are structured in a fashion that unless you read those revenue contract agreements, you will not realize that it's so complex that every contract will give you a different answer. So one contract which was signed before is not necessarily an exact replica in the subsequent contract. So it's important that these long-term complex contracts have to be evaluated for various things. One is the revenue measured at fair value? Is it a cash or non-cash? Should I be doing the netting off? Whether I'm a principal or an agent in this entire transaction, and I'll pick example in the subsequent one. I'll give you a real life example so that you can understand this. Are there multiple performance obligation? How do you allocate transaction price? We'll talk about it in that example. When should I record revenue? Should I be recording revenue now, or should I record it in a staggered basis? How do I account for all the discounts I'm offering to my customer? Should I upfront the discount? Should I stagger the discount? Should I show discount net of revenue? Should I show discount gross of revenue? How should I do this? If I have invested money to get a contract, let's say I've built accelerators, I've made certain investment for 1 or 2 months to make sure that the customer is happy with that I have the right capability. Should I be accounting this as customer acquisition cost, or should I be charging it as customer fulfillment cost? If I do contract acquisition cost, I may be in a position to defer this acquisition cost over the contract period, which enables me to help me do my P&L management better compared to contract fulfillment, which goes into the P&L immediately. What are the extensive disclosure requirement, right? We speak about now, because of revised schedule 3, there's an aging bucket of all the customers. There's a requirement of giving contract assets. There's a requirement of giving the entire contract revenue reconciliation. All of that, how do you deal with it? Okay. So these are the various complex things which are there in revenue recognition. Now, the important thing here is, if you notice, and I'll quickly walk you through, the first thing you will do when you are dealing with this kind of a large technology company, all of them are very mature, is to first do something called a process walkthrough. You need to walk the floor where revenue is being recorded. All these companies use different jargons. They use O2C, which is order to cash. This is one term which they use. They'll say there is a separate revenue recognition team. There's a separate planning team. There's a separate budgeting team. And there is also a separate team which does into operations management. So you have to understand by doing a walkthrough of the entire end-to-end process. This will give you an understanding of, hey, where does the process start? Where does it end? In this entire understanding of the process, you should be able to determine, are there any risk of material misstatement? Is there a risk of fraud? That's your first tick box. Once you determine that, hey, yes, there could be potential risk of fraud, there should be potential risk of material misstatement, then you will do special procedures around that or get your forensic team involved. Apart from that, you will also notice that, hey, some of these processes or sub-processes is within the ERP system or within a technology, or some of them are outside technology. It is manual. So if you go back to my couple of previous slides, I spoke about IT controls, which is automated controls, IT dependent manual controls, more manual. Then you'll make the segregation. Basis that you'll also do the entire control testing. Once that control testing is done, you'll also go ahead and do a expectation in terms of analytics. You'll perform analytics. Hey, is the pricing gone up or down? Is my charge out rate to my customer gone up or down? That's what you will do. A lot of analytics. Once the control testing is done, once the analytics is performed, you'll be able to identify, hey, this has given me some amount of comfort. I need balanced comfort. That's when you go to substantive testing. That's when you ask, hey, customer, hey, client, give me the entire information in terms of this particular contract. I want to determine that this contract is existing. I want to send out a confirmation to the customer that this invoice, which I have shown it against you, is really an outstanding invoice. You will perform all this for you to get the comfort on ER. But more importantly, how do I control my revenue? Please keep in mind uh, uh, these are all companies which have their asset base as humans, right? Their revenue is nothing but timesheet converted into a particular rate, or if it is a fixed price contract, the total input divided by the total cost into the contract revenue will give you the total contract value will give you the contract revenue. So it's important that you are able to go and audit their timesheet system, because without the timesheet system, if you don't understand how the timesheet is being recorded, processed, evaluated, and the revenue is calculated, you will struggle to see what should be a recognizable revenue, what should be deferred revenue, what should be unbilled revenue, unearned revenue. Variety of terminologies are being used in these large tech companies. For you to understand that in greater detail, you can audit them. It's important to do a thorough walkthrough, do an identification of potential risk of material misstatement of fraud, then do a control testing, substantive analytical procedures, and then you'll get to this substantive test of details, which will give you a comfort that, hey, whatever they are showing me revenue, they are able to disaggregate this revenue and give me, with for every sample I select, they're able to give me evidence that this particular contract actually is existing. There are original contracts, and I'm able to verify those contracts. Backing the revenue accounting, I can go back and see the timesheet of people. Because I want to know whether these people are existing, I'm able to link it back to the HR records to justify these people are working, and these people are working and only charging their time into this particular project or contract. Because without this detailed understanding of how their process works, it's extremely difficult for you to go and challenge whether the revenue which they have recorded is accurate, inaccurate, not following the principles of Ind AS 115 or not. Because then it's easy for any client, for that matter, they'll say, hey, you don't understand my system. So it's very, so whatever challenge you say, throw at me, I will say this is already system given, go and check how the system is working. So that is where it's important that we as auditors learn, do a thorough walkthrough, understand the systems, ask more questions, and bring the specialist if required, just so that you are able to get a better understanding of this entire process. So if I take an example, and this will give you a good example of how a large IT company would probably enter into a contract, and I've taken one example each for every standard to make it easy for all of you to understand. Notice this particular contract which I've entered into. This is under Ind AS 115, relative selling price. Okay. In this example, the company is entering into an agreement to sell hardware, professional services, and maintenance contract. This is very typical of large IT companies. Because the customer, let's say you are a large bank. Okay, I am XYZ bank. I will say, hey, Mr. Hey Infosys, hey TCS, hey HCL. I am just giving hey Mindtree, hey LTI. I don't want to go to multiple vendors. Can you come and put the entire server with me? 500 laptops. Can you come and implement this particular solution? And also post implementation, provide me maintenance services. Are you able to give me end-to-end turnkey solution? Many of these large ITS companies says, yes, I can give you, because I have the ability to do this end-to-end thing. I have a team which can do. I am not a hardware manufacturer. I will buy wherever I have to buy hardware. I have to buy a Lenovo laptop, I'll buy it for you. I have to buy an IBM server, I'll buy it for you. I'll integrate all of them. I'll give you professional services, and post professional services, I'll maintain this for you. Now, this is how large turnkey projects, contracts are entered into. Now, the challenge which you notice here, there are things which is in the control of the company, whether it is professional services, maintenance. The hardware is not manufactured by this entity. And then all of this is being bundled into one contract and being sold to the company. Now, if you read these many of these contracts in my past experience have, and even now when I keep reading, these are 100, 200 pages contracts, very detailed. Many of them are so much technical in jargon that you may or may not be able to fully follow unless you understand the industry very well. That's when the challenge arises. Hey, as an auditor, how are you able to audit this complex contract? So if you notice here, if I go on further, the first thing, because under the 115, you have to determine whether the contract is existing, etc., etc. That 5-step model, they have determined the 5-step model. In that 5-step, they have determined that entity, each of the promised goods, which is hardware, professional services, and maintenance, or services, represents a separate performance obligation. They are saying there are 3 separate performance obligations. because entity frequencies sells professional services, maintenance on a standalone basis. It uses those transactions to determine the standalone selling price of 25,000 for professional services, 15,000 for maintenance. Look at the quantum. I have a 200,000, 2 lakh or 200,000 contract, but my service professional services is not more than 40,000. The entity rarely sells the hardware on a standalone basis, so it estimates standalone selling price at 185 based on the hardware underlying the cost. Entity's targeted cost and amount of margin, the entity believes the market will bear, expected cost plus margin method. Now, if you notice here, complex contract, three different things which the company is willing to do. Now the question arises, hey, how I as an auditor will have to look at this contract? How should I evaluate? What should I be expecting from the customer to give me? And the customer should give me, or the client in this case, should give me a detailed Ind AS 115 revenue recognition memo explaining how they have gone about evaluating this contract under 115. How did they get to an answer that there are separate performance obligation? How did they get, how are they able to justify 25,000 and 15,000 and 1,85,000? If you add all three, you will notice that this is 2,25,000, but I'm selling it for 2 lakh, right? Or 200,000. So it's very, so then you'll start thinking, okay, what do I do with this contract? And how do I go ahead and account? So it's important that your client is able to provide a thorough, well-written accounting position paper, which will explain to the auditor and the management that this is how they are going about doing and their compliance with 115, so that anybody comes, they are able to verify this independently. Now, having seen this example, if you notice how we have gone about doing, this is how the position without getting into the other elements of the position paper, which they'll give you. If I have to tell you how the company should be accounting, first is estimated standalone selling price, 2,25,000 or 225,000. From a relative sales value method, if you notice, 82%, 11%, 6%. Now, against this, I have offered the customer a bundled price of 200,000. For this 200,000, now I have to start allocating based on the relative weightage which is given to each of these, because the total cost is the total price is 225. I have gone about, I gave a bundle discount of 25. Somebody can argue, why don't you allocate entire 25,000 to the bigger one? It may so happen if I allocate that way, then I will get to a situation that my hardware cost is equal to the hardware selling price and I don't make any margin, or it may be a loss. So it's important that the standard, the way the standard is written today, you are able to allocate based on your standalone selling price. You arrive at the new allocation transaction price, which is 164, 22, and 13. So this is the basis on which the company has to go ahead and account the revenue. It may so happen that the company may have written different values in the contract. Doesn't matter. It will not help if you say contract is telling you 175. Can I go ahead and record 175? Answer is a clear no. Even if it is said 175, we don't care, because then the basis of 115 valuation is it is getting to a new allocated transaction price, which is 164. So even though something else is written, it's not necessarily the fair value. So this will be the revised way of calculating. And this is the basis on which a recording of revenue should happen. Otherwise, if you just go by what is written in the contract, you may get to an incorrect revenue recognition. And that will, I am talking about only 200,000 rupees here. Imagine this being a huge 200 million. Then the entire number could be a significant misstatement. That is where you have to be very mindful and make sure that you force the company to give you a thorough analysis, and basis that you will be able to conclude. Okay. So if I take this example further, notice this example. Assume the same fact as example, except that the arrangement also includes software. Okay. Apart from hardware, professional services, maintenance, there is also a software which is being sold for a total fee of 250,000. From 200, it has moved to 250. Entity determines that the software deliverable is also a separate performance obligation. Now there are four: hardware, software, professional services, maintenance. So there are four. Entity never sells the software on a standalone basis, because and now that there is no value for that, because we are saying software, I don't know at what price I've been selling, because I have standalone selling price for only hardware and the other arrangements, which is the professional services and maintenance. So if you notice here, under the residual method, They're saying 250 was the value. My hardware is 185. That is what I have determined. Professional services is 25. Maintenance is 15. Based on this, the standalone selling price of software, which I cannot determine here, is 25. This is how they have determined, and this is a method which is given in the Ind AS 115. And this method is called the residual approach. So all these things becomes, as you can notice, we have taken the same agreement, made some modifications, and got to a different answer in the way the allocation is happening. So this is where the revenue recognition as a element or the class of transaction within a large IT company can be your biggest item for you to verify thoroughly. If you get something wrong there, the entire top line goes wrong, margin goes wrong, the EBITDA goes wrong, and what you went with EPS, etc., to the market, everything is wrong. And it could be a big embarrassment. Two quarters, 3 quarters down the line, if you say, sorry, we got this entire contract wrong, and we are now doing a restatement, then the market will beat you down with the fact that, okay, you told me a wrong number, because of which I gave you a price, a P multiple. Now, because of this, I don't know whether I can trust you, so they can bring down the entire market capitalization. So we as auditors have to be very, very careful, especially dealing with revenue recognition as a standard, because it's a very complex standard. And more importantly, the complex contracts which the IT companies enter into further makes our life more difficult, because it's a contract by contract evaluation. There is no straightforward rule. Just take that contract and go with the previous assumption. Moving forward, there are other examples, but in the interest of time, I will move forward and I will skip some of these examples. There is one more example in terms of licenses and royalty. I'll spend a minute there. There are all these new companies which are now also not only selling their hardware software, they also have their own existing software, which most of them have developed. Now, they now start selling those software. So how to account for those sale of software licenses? Also, there is a separate guidance within Ind AS 115. Again, as I mentioned, this will require detailed evaluation whether the software product which I'm selling is my own software or a third-party software which I've bought and sold. And am I giving the right to use or only giving an access, right to access? So evaluating all of this and getting the accounting position paper from your large IT company becomes important. Otherwise, it may be that the way you have recorded revenue can go completely wrong. Another big standard which has an impact on ITS companies is the leasing standard. All of you know, we are starting 1 April 20. That's true. 1 April 20, India went live with the Ind AS 116. And now the 116 had a big impact on the balance sheet of every other large company globally. Why did it have an impact? We had the concept of finance leases, which came onto balance sheet, because the moment we concluded that it was a finance lease, we brought it to balance sheet, finance lease assets and finance lease payable. What we never brought to balance sheet was all the operating leases. We said operating leases are outside the perimeter of balance sheet. It used to be a notes to account disclosure, lease commitment of 0 to 1 year, 1 to 5 years, 5 years and above. That's how we used to give and go away. Now, this created a lot of accounting mismatch, if you will, in the context of especially the IT companies. I'll give you an example. If a company A is operating completely out of their own premises, now that if you look at the own premises, you will notice that you will have a depreciation charge coming onto your P&L. Now, think of EBITDA, EBITDA. EBITDA is before depreciation and interest, right? Now, this company, which is operating from its own premises, will have a higher EBITDA. Why higher EBITDA? Because I only have my own assets, and the charge of the assets is coming below the EBITDA. Take a similar company with same number of people, same type of contracts, similar in size, but completely operating from a rented premise. Suddenly, if you notice the two profit and loss account of these two companies, especially in the IT sector, because they take a lot of office premises, either they own it or they lease it. One company's EBITDA will show, let's say, as an example, 25%, because depreciation will come below the EBITDA. Another company of similar size, similar nature, will have an EBITDA of 20. This 5% delta, if you notice, will be because there is a rental charge in company 2 sitting in the P&L. Now, this was an accounting mismatch, which a lot of analysts were adjusting when they were giving the valuation. Company operating on its own premises, EBITDA is higher. Company operating from leased premises, EBITDA is lower. But when it comes to PAT or PBT, profit before tax, because depreciation used to kick in, let's say both were same. But a lot of us know, driven by various KPIs, the key performance indicators, one of the largest KPI for technology companies could be EBITDA. And that used to be a good debate or a big debate in terms of what is the real EBITDA? Is there an adjusted EBITDA, etc., etc. That's when the regulators formed this new standard. They came in saying that, hey, even operating leases, obviously there are certain scope exclusions, I'll not get there. With those scope exclusions, the operating leases will also now come on the balance sheet. And those things, which used to be called as outside the balance sheet or off balance sheet items, will now come and sit on balance sheet. And those now off balance sheet items which have come on are now called right of use assets. And obviously there's a liability attached to it. So automatically, this particular mismatch of rent versus depreciation is now adjusted, because now these companies which are also having leased assets will now charge not a rental, but amortization on the right of use assets. So automatically there is a EBITDA adjustment coming through the financial statement itself. So it was a big standard. Now think of this standard having a significant impact on the companies, technology companies. As I mentioned, always this particular standard is not limited to real estate leases. Most of the companies, I may stand corrected on this in terms of data point, most of the technology companies take their laptops on leases, which is their biggest asset, right? Because they have thousands of employees, lakhs of employees rather, who have to have these laptops, which will be running for 2 years, 3 years. They all take all of them on lease. Their servers could be on lease. Now, most of their thing is sitting on the cloud, right? Whether it is any of these third-party clouds, Azure, Google, Amazon, AWS, all of them are cloud. So that there is also leases there. So all of these, as I said, printers, think of anything. Now, most of them are going into a lease model, not necessarily an own model, because it could be cash flow, it could be cash management, etc., balance sheet management. So all of this will lead to a situation that, hey, all this is complex, because each of those leases will have different termination clauses, different interest rates, different periods for which they are operating. How do you run a system to make sure that all these leases are captured in one place? That's the first thing, right? You should have a proper list of by the management in terms of all the contracts, lease contracts, and there should be a central repository. First thing is, how do I know that this is accurate? How do I know that something is not missing? How do I know that there are data points sitting with different departments which are not necessarily available with finance team? So all of this will become a difficult task for the auditor to go and check, because unless there is a good robust system, there is always a potential of missing those items. And especially you cannot sit and do a ledger verification to identify, are there different rental agreements or hire purchase agreements or different names called, which you have missed out in your 116 leases. So it's important to go and verify their system. If it is spreadsheet, then the spreadsheet controls around it. If there is no control, then the substantive testing. All of that have to be taken into consideration before you go and then start doing either a control-based audit, a control plus analyticals plus substantive. It's a combination of all of that. This also needs to be seen. This, as I mentioned, also has a big balance sheet impact. Because you brought the right of use assets, now suddenly there is a significant liability sitting on your left-hand side, which also had a big impact on the balance sheet itself. If there is a potential risk of material misstatement or a fraud risk, you have to consider that, because leaving out certain contracts outside of the lease perimeter can improve the balance sheet position. So that also is something which you as auditors have to carefully keep in mind when evaluating another big standard called lease, because this lease also is a significant impacting item for your ITS companies. There are a couple of other transactions. I'll take 5 more minutes before I stop. Accounting for equity transaction. You must have heard about a lot of large companies doing buybacks. When do you do how should you do account for buyback provision? They also enter into complex derivative contracts, put option, call option, forward contracts. All of these are complex contracts which are existing in all these ITS companies. Because think of it, they are exposed to multiple currency risk, right? They deal with customers who are different geographies. They are customers in the US, customers in Europe, customers in the Middle East region, yeah, Asia Pac region. There are different types of customers. Then they have to have a view of how these currencies will move against the rupee, how these currencies will move against the dollar. So they will basis that their treasury operations will take hedging contracts, not necessarily speculative contracts, hedging contracts to make sure that the balance sheet of P&L is protected. Once these contracts are entered into, they enter into complex contracts. It could be a put option or a call option. It could also be cross currency swaps, because I may buy something, I may have to leverage that and settle something else. All of this becomes an important element in terms of a detailed evaluation by the auditor. Why this is complex? Because financial instrument is a standard. Ind AS 109 or IFRS 9 and IAS 32 is not a very simple standard for a lot of us to understand. I keep saying this jokingly. If I'm not getting sound sleep, and if I really want a sound sleep, I open Ind AS IFRS 9 after the 10th or 15th page. Then because it's so verbose and it's so technical, I start getting a sound sleep, because after the point in time it becomes difficult for us to understand. So that is jokes apart. But on a serious note, what is important is these are complex contracts. So from an auditing point of view, you will have to again ask for an accounting position paper from the company for you to evaluate how did they get to certain transactions being pure equity, pure liability, a hybrid instrument, the entire hedging conclusion. All of that will become a significant area for and a key risk area, because this is not a simple. The number of people within the organization, within the company itself, will be fairly limited who can understand this complex contracts, who can understand this complex financial instrument. So it's not a run-of-the-mill finance and accounting person's job to understand these complex things. So their accounting conclusion can also change the way the profit and loss account and balance sheet appears. So very important that you are giving a lot more thrust on this particular equity transaction area, especially in the ITS companies, because they enter into these kind of transactions very regularly. They're also into the business of acquiring quite a lot of targets. They are one of the most acquisitive companies, if you will, because they keep looking for smaller companies whom they can acquire and start merging them. So in terms of acquisition accounting, you'll have to identify another big challenge in acquisition accounting is the quantum of goodwill which will come and sit on your balance sheet. Because if there is a significant goodwill which sits on balance sheet, unlike the Indian GAAP where we used to amortize goodwill, there's no concept of amortization of goodwill in the India scenario. You only have to test it for impairment. So the more significant goodwill you have on your balance sheet, there will always be that entire evaluation on a quarterly basis or every reporting basis. Does this goodwill need to be ascertained for impairment? Why did, or even before impairment, how did you create such a significant goodwill? Did you try ascribing a significant value for the business, which does not have? And the biggest challenge will be a couple of quarters down the line or a couple of years down the line, if you start writing off that goodwill because it is impaired, a lot of questions will be asked was, how did you even account for the goodwill in the first place? Was it wrong? Was it incorrect at that point in time? So important consideration from an ITS company's point of view, that you have to evaluate these acquisition accounting very carefully, because there is a lot of challenge. Same thing is with business combination. It could be amalgamation, it could be merger, it could be demerger. All these things, whether it is common control or non-common control, has a lot of challenges which the company has to deal with. In the interest of time, I will skip some of these because I may not have time to go through all. But it's important for you to consider that this is another big element for you to consider when you're auditing the ITS companies. The last one of the lot will be stock option. Again, the companies are, IT companies are very famous for giving stock option to all their employees. Again, it's a very complex area, whether it's an equity settled stock option, cash settled stock option, is it hybrid? You have to see all that, and basis that, whether it is stock option given, the large listed companies will have it under their company itself. But if it is a subsidiary which is receiving the stock option of the parent, how should you account for it? This again becomes a very complex area in terms of auditing, whether these stock option schemes are in compliance with SEBI, whether they are in compliance with Ind AS 102 or IFRS 2. whether this is graded vesting, whether this is a straight line vesting, how to do the entire Black-Scholes model. All of that could be complex areas for the auditor to deal with. Not an easy topic, not easy to conclude. One wrong calculation can have a significant impact on the P&L and balance sheet, because you carry a stock option compensation expense and also a stock option reserve on your balance sheet. So keep this in mind. So it's important for us to notice that while the fundamentals or 101 of audit I've already explained, keep in mind from a technology company point of view, they will expect all the auditors to be more tech savvy. Take the data from their own core systems, do all the checks and balances in the background, arrive at things which are outliers, go and challenge them, then they are more than happy to explain. But if you go and say this is rudimentary, then they'll say, hey, you have not evolved. But once you have evolved, then they'll say, hey, these are my complex transactions. Please audit them. That's also not easy, because as more and more changes are happening in the world, their contracts are also becoming more and more complex, whether it is business combination contracts or stock option contracts or your revenue contracts, as I mentioned. Each of them are complex areas in this particular space for you to please consider. I will stop there. I know I was given at 5:30 to stop by Aman, but I'll stop there and I will hand it back to Aman to see if there are any questions. More than happy to take. I know we have only 13 odd minutes left, but more than happy to take the question.
Thank you so much, sir, for such a wonderful deliberation. There are certain questions. If you want to continue, if presentation is there, but it's already 5:50, so I have certain questions. Sir, the first question is, which software package is best for audit of IT sector?
Say that again. Sorry.
Which software package is best for audit of IT sector?
Which software is good for? No, there is no. I mean, each of the auditing team will have their own internal audit software. There is no universal audit software that way to go and audit this IT sector. Because IT companies may be using various technologies of their own. Some of the companies use SAP, some companies use Oracle, some companies use JD Edwards Barn, some of them are using Microsoft Dynamics, some of them are using their own bespoke system. So there is, to me, all of these are core ERP systems. Beyond these ERP systems, there are also other softwares which those technology companies use, like the CRM software, the time management software. All of that, we as auditors have to take the data from them, directly connect the data or ask them to give a dump of the data, use our own internal softwares. I'm sure all of you have developed your own internal software, or there are market available software. I don't want to keep, I don't want to recommend a particular software of that nature, because you need to have a good data analysis software. What will the data analysis software do? The data analysis software will go and check, are there any outliers in the data given by your IT company? Are there segregation of duty conflicts? Are they missing certain process? So basis that you will be able to go and challenge the company.
Yes. So how do we relate documentation with audit evidence in risk management, risk assessment?
Okay. Well, I had walked you through the entire risk assessment process. If you notice the risk assessment, in the process of combined risk assessment, you have to see the impact of the risk assessment on the, and basis that you will have to first identify if there are any fraud risk indicators, risk of material misstatement. All of that have to be evaluated. There's a step-by-step process. Our auditing standards give you the detailed guidance of how to do that. Once you get to an answer that, okay, basis your assessment, let's say on revenue, which is a significant class of transaction, you believe that the risk of material misstatement or risk of fraud is only medium, not very high, because there are good checks and balances. The board, audit committee, all of them meet on a monthly basis, review all the things, etc., give you a comfort, and also the IT comfort is high. You get to an answer that this is only medium risk. Then the level of testing, and you also do an analytics procedure, which gives you a comfort that whatever expectation you were setting was not different from the outcome. Basis that your substantive testing will be low. So if you notice this entire audit planning, you got to an answer at the beginning based on inquiries, third-party procedures, risk assessment, control testing. This has to be documented the way the auditing standard on documentation is highlighting. That's a basis of documenting, and More importantly, if I read, as an example, if I read your documentation, I should be able to get to a similar conclusion, not exactly same conclusion, like the way you have got to that conclusion. So important thing is it should meet the reperformance standard. There is, while there is an art to writing there is art to writing your documentation. There is also science behind it in terms of writing the auditing documentation. The more important thing is, will it meet the reperformance standard? More importantly, if you ask me, based on my experience, a lot of us keep all those things in our head here. If somebody says, okay, tell me this, we are in a conversation, we can explain everything. I asked many of my colleagues or team members. I said, great, but I can't audit your head because everything is in your head. Where is it in my work paper? If it is not there in work paper, not documented in my definition is not done. Not that they have not done it, but because I can't see anything done and I can't audit that human brain, I'll say it is not done. Kindly go ahead and document. So the trick to documentation is, if you read it independently, without that person being in front of you, can you understand everything that person has written? If the answer is no, then the documentation is not good.
Yes. So one member is asking, could you put some light on the methodology of income recognition for IT sector? IT company में किस तरह से we can recognize it?
So income recognition for IT sector, as I give you one example of a contract which the company has entered into. Most of the large IT sector companies enter into these turnkey contracts. One example I walked you through, where they were selling hardware, they were selling professional services, where they were selling maintenance. In some cases, they also sell software. If you notice that entire example, that will give you a clarity. More than 50% of their contract will be like that. The balance 50% of the contract, they send people whenever the customer says, hey, I need 200 people who can come and build certain platforms for me, but I will control those people. So send me on a time and material basis. So that those kind of contract, in layman terms, it's fairly simple to handle, because you are looking at the rate per hour, the number of hours that a particular employee has spent, multiplied into the number of the rate which he has been given. And if the customer says, hey, some of them are wasted hours, I will not pay you. So that's an easy recognition. But when it comes to these complex turnkey contracts, where there is all these bundled contracts, as I call it, where there are multiple things embedded inside that, India, the first thing as I mentioned, please ask for an accounting position paper from that client, who will tell you why they have combined all the four into one, or why they have split the four into individually. And then, basis that, have they given you standalone selling prices or relative transaction price? And the basis that, are they doing recording on a monthly basis? Importantly, this is again a software company. All of this will not be in Excel spreadsheet. All of them will be sitting in their ERP systems or some revenue recognition system. Do you have team members from IT or from technology background who can audit that software to give you comfort that every contract which went in with all these split, it is able to calculate the entire revenue properly? So the way you audit income or revenue recognition for a software or an ITS company is, split the contracts into these large buckets: complex turnkey contracts, run-of-the-mill contracts, maintenance contracts, and then based on categorization and your risk assessment and control testing, you go ahead and do the audit.
So similar question: how the assets are written off in an IT industry? Assets are written off in an IT industry.
Assets are written off. Okay, let me split this into two buckets. I'll assume that some of these are regular assets which we are talking about. It could be servers, it could be laptops, it could be printers. These, what the member is probably asking is, how do you write off these assets?
Yes.
The most common thing is, all these companies are also good are companies which focus on sustainability. They sell if these assets are on lease basis, obviously it will go back to the original equipment manufacturer who will dispose these assets. So there is no asset discarding which I have to do, because these are not legally owned by me. It goes back to the main manufacturer after my lease term. Let's take scenario 2 where I own these assets. So then what I do is, after the useful life is completed, and if the asset is no longer in good working condition, in some cases, I have noticed that these companies want to give these assets to education institution, downtrodden people, etc., so that they can use those laptops. Or if it is really not a good usable condition, they give it to the waste management companies to do a safe electronic disposal.
So last question. This is a one illustration type question. Member is saying the company has an auto bank reconciliation in ERP, and the finance team does not preserve and download the bank statement from the bank because BRS is monitored on daily basis and are always up to date. It is Herculean task to get the statement from them due to the access and authorizing hierarchy in the bank. They say everything is recorded and fully reconciled. Accounts payable is kept at the rate of at maximum 15 days PT. Please suggest if it is fine, that approach they are taken is fine or okay.
So the bank reconciliation as a process, the process looks good to me. The reason being it's automated and not manual, because they are able to import the bank files directly from the bank portal into the system, because of which the process of reconciliation is no longer manual. I don't have to keep uploading the bank statement and doing this monthly manual process. It's a very good, robust process. But the question arises as an auditor, how do you verify this process? Because this is completely automated, not manual. There are direct data interface between the ERP system to the bank systems, and there is no manual intervention. So somebody has to go and audit this to give you a comfort that the bank reconciliation process, which is appearing to be highly automated, you have a comfort on that automated process. So you will be able to tick the bank reconciliation process okay. But if you notice from a balance sheet assertion point of view, and one of the slide was balance sheet assertion, I also have to assert whether there is existence of that bank. And if you notice that entire process, in the cash and bank balances, it said confirmation. Auditor cannot not do the confirmation. You have to do the external confirmation, which will give you comfort that those bank balances and the numbers which are showing behind that is comfortably available. But from a reconciliation process point of view, the process looks good. For you to test that, in my view, personal view, it will be more automated automated system control, which has to be done through a system testing.
Yes, yes. Now we come to an end, sir. You have justified with your presentation, and you have taken a whole 2 hours for this presentation without any break. So thank you so much, sir, on behalf of SSB of ICI for spending your valuable time and enlighten all of us on various considerations in the IT sector. And you have justified with your presentation as well as answers of all the queries raised by the members. If afterwards, if I receive any query, then I'll forward to you through mail, then I will revert to the concerned member. So once again, thank
Pleasure
you
is
so
all
much, sir,
mine.
for such a wonderful and detailed deliberation in a very lucid manner, in a very lucid language, and it was really good as well as we are feeling honored to have you on this platform, sir. Thank you so much, sir, once again on behalf of the SSB of ICI. Thank you. Namaste.
Thank you very much. Pleasure is all mine. And I really thank the ICI for giving me this platform and opportunity for sharing my professional experience. Really appreciate all of you, all the members for listening in for 120 minutes. It's not easy. Really appreciate all of you. You guys have a good evening. Thank you very much.
Thank you, sir. Thank you.
Thank you.